The U.S. banking industry is facing a deepening crisis, with First Republic Bank's market capitalization falling below $1 billion on Wednesday. The bank's opening was suspended 5 times, and its decline during the day expanded to nearly 40%, largely due to a worse-than-expected loss of deposits in March, with up to $100 billion lost, while White House officials, along with representatives from the Federal Reserve and the Treasury Department, have contacted First Republic Bank to reassure depositors and investors. They are hesitant to intervene in the bank's rescue process at this time. Recent bankruptcies of Silicon Valley Bank and Signature Bank have put the U.S. government on high alert. The ongoing debt ceiling impasse is exacerbating the situation, and failure to reach an agreement by the end of June could result in the first-ever U.S. default, causing severe harm to the economy and finance, as well as further endangering the dollar's international status. Moody's analysts warn that such a default could hasten the end of U.S. international hegemony and spell the financial doom of the dollar as the world's primary reserve currency. The U.S. dollar's dominant position in global trade and commodities has led to an accelerated de-dollarization by global central banks. This, coupled with concerns over potential debt defaults, has eroded trust in the dollar and U.S. treasuries worldwide. Central banks are liquidating U.S. debt at an increasing pace and turning to gold as a store of value. Even Middle Eastern oil-producing nations are de-dollarizing by using non-dollar transactions. The dollar's decline indicates that it may not have the longevity it once did, and gold may emerge as the real gold standard. Arkansas has become the 22nd state to officially declare gold a legal tender alongside the U.S. dollar. Texas authorities are planning to create a digital currency anchored to gold that would serve as an alternative to the U.S. dollar and allow consumers to exchange it for gold. Additionally, since April 6, U.S. lawmakers have urged the U.S. Treasury to return to the gold standard, and a recent proposal by Alex Moody would require the U.S. Treasury and the Federal Reserve to disclose the amount of gold stocks held in custody for over 60 countries in the past 60 years, as well as the associated financial transactions. The proposal also mandates the physical audit of these gold reserves by the U.S. Comptroller General. More than half a century ago, over 60 countries held nearly 7,000 tons of gold at the Federal Reserve. However, some experts believe that the U.S. Treasury and the Federal Reserve may have sold, swapped, leased, or pledged some of the gold over time. The Federal Reserve has denied or obstructed requests from Germany, China, Venezuela, and other nations to return their gold. The lack of transparency by federal authorities has eroded public confidence, and countries are now concerned about the safety of gold stored in the U.S. Based on the latest report by the U.S. Treasury on international capital flows, the U.S. financial markets are not only facing a crisis of confidence but also a debt crisis. The report reveals that at least 20 countries, including Japan and China, the top 2 U.S. creditors and allies, have sold varying amounts of U.S. treasuries as of February. In particular, China's U.S. debt holdings have hit a 13-year low of just $8 billion, indicating the 7th consecutive month of selling U.S. debt and the 11th consecutive month of holding below $1 trillion. Since 2022, China has been accelerating the process of liquidating and de-dollarizing its U.S. debt while significantly increasing its gold reserves, as recent Swiss customs data shows. According to the data, China's gold imports from Switzerland have increased by 69% since the beginning of this year compared to the same period last year, reflecting a rising demand for physical commodities in the country. In the first quarter of this year, China's gold demand reached 465 tons, the highest level since 2019. Switzerland alone shipped 146 tons of gold to China in January and February of this year, up 72% from December last year, indicating the most significant gold shipment since 2018. These figures highlight China's increasing influence on the global gold market, which is further confirmed by the World Gold Council report, showing that China's gold imports had their strongest quarterly performance since 2015. As major buyers of U.S. debt continue to reduce their exposure to the dollar by buying non-dollar currency assets such as gold, China's move to increase its demand for gold is significant. However, the U.S. is facing the risk of defaulting on its debt, as U.S. Treasury Secretary Yellen reiterated this concern in a letter to Congress on April 27, urging Congress to raise the federal debt ceiling. Yellen warns that if the U.S. debt ceiling problem is not resolved, it may result in defaulting on the debt. which will undermine the economic gains of the past 2 years and may severely impact the dominant position of the dollar, bringing a double disaster to the U.S. economy and financial system. This scenario may lead to a massive sell-off of U.S. debt by global central banks such as Japan and China, amounting to $700 billion to reduce their exposure to the dollar. If this happens, the dominant position of the dollar will be significantly impacted, and the U.S. economy and finance will be greatly affected. Moreover, U.S. media reports suggest that the U.S. may use gold to pay off its debt and interest. This is because the basic law of the United States states that bondholders must be paid, meaning that the U.S. must pay off its debts and pay interest without defaulting. Presently, the Federal Reserve faces a dilemma of debt default and recession expectation. To maintain the U.S. debt and the credit of the dollar, it may have to agree to countries that want to ship back their gold reserves. In conclusion, the U.S. debt problem is a significant issue, and if the risk of defaulting on the debt increases, it may lead to a massive sell-off of U.S. debt by global central banks, which will have a severe impact on the U.S. economy and finance. Furthermore, the U.S. may use gold to pay off its debt and interest to maintain the credit of U.S. debt and the U.S. dollar. Therefore, it is crucial for the U.S. government to address the debt ceiling issue and come up with solutions to prevent further deterioration of the economy and financial system.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.